The fund's objective is to deliver capital growth over a rolling 5-year period through investing in Japanese equities. We adopt a long-term, bottom-up, growth-orientated approach to investing. This allows us to invest in companies across all areas of the economy, be it in areas often associated with growth investing, such as capital-light companies involved in e-commerce and broader digitalization, to other more traditional areas, such as robotics and automation, or Japanese manufacturers, those involved in producing complex electronic components as a result of the Japanese concept of Kaizen, years of fastidious continuous improvement. Or indeed more niche areas like gaming, an area where Japan has particular strength in. As a result, I'd say our biggest differentiation comes through that flexible approach to growth investing, along with our ability to assess and invest in these companies for significant periods of time. Yeah, so in terms of sourcing new ideas, all members of the team are tasked with generating original investment ideas. These can come from a variety of sources, such as extended trips to Japan, or on-the-ground research from our independent research analysts based in Tokyo, conversations with our international colleagues, or competitor analysis of our current holdings, or even reading days. Encouraging investors to follow their intuition and enthusiasm in this way has actually been quite fruitful in generating a strong flow of new ideas. And this slightly unconventional approach also allows us to avoid the prejudice or bias that can accompany a more thematic screening process. If the stock is then purchased, it can be held for a number of years. The average holding period for the fund is over 9 years. Some stocks have been held for even longer. So 42% of the portfolio, so almost half of the fund, is in companies that we've held for over 10 years. Some have been held for 20 years or so. Keyence, a company focused on vision and sensory systems for machines, was bought back in 2003. And Cow, a company that manufactures household goods, has been held for even longer, since the 90s, I believe. Over the last year, the fund has delivered about 21% versus 18% from the index. Over the last 3 years, it's delivered 22% versus 12% on the index. Now, although these numbers are attractive and favorable to the fund, given the long-term focus of this fund, we would ask that clients discount these numbers, as very little can be inferred from such a short period. Instead, we'd ask clients to judge us on our longer-term record, and over 5 years, the fund has delivered over 12% annualized versus about 7% for the topics. Upside downside capture it has been quite favorable for the fund, but I'd say that we tend to underperform when there's a significant market shock. So when there is an indiscriminate selling of stocks and when share prices effectively divorce from fundamentals. Last year, for example, our high weighting to internet-related names helped performance quite a bit. This year, on the other hand, has been a bit more challenging as more cyclically depressed names have bounced back. That said, our exposure to some recruitment companies, robotics, auto and related companies have performed quite well on that cyclical revival in their respective industries, and so has helped performance.